All right, and we are back, and this is kind of exciting. We finished the official part one of the book, Personal Mindset, and now we're going to be moving into part two, Personal Finance. And we're going to be going over, in this particular video, we're going to be going over Chapter 5, Loss Protection. I really like this quote by Benjamin Franklin: "An ounce of prevention is worth a pound of cure." All right, right? If we can, build in those buffers that I've been talking about throughout our videos, then that's going to really help us for some of those unexpected events that happen in our life. And we're going to be talking about that in this chapter. All right. So in previous chapters, I emphasized the importance of developing a solid personal mindset as the foundation for building your financial independence. Now, following the principle of layering, I'll introduce another strand to strengthen the rope, ensuring that your financial independence remains secure even in the face of tragedy. This next layer consists of risk management strategies, and I recommend using all four to protect yourself. Since you don't know when emergencies, accidents, or deaths will occur, you need specific insurance and cash reserves established before any of these events arise. Also, because there are so many variables regarding insurance policies, I've decided to help to keep the details to a minimum. Thus, you will be responsible for doing additional research to find the best policies that fit your unique situation. While these risk management strategies are an ongoing drain on your income, you should still consider yourself blessed if you never need to use them. Be happy that you can rest peacefully at night, knowing everything is in place to protect you and your family financially from unfortunate events. Okay, I'll assume that you already have adequate home and auto insurance, so I'm not going to include them in this section. In the rare case you don't, please meet with your property and casualty insurance agent to discuss the best options for you. I'll also briefly mention that if you have young children, you should have a will in place, if for no other reason than to direct where to place them upon your untimely demise. The judge will look to your will for guidance on which family members or friends you would want them to be with to receive the best love and care. Okay, really important. So if you don't already have a will, please meet with an estate attorney. Now, on to understanding risk. One way to define risk is the uncertainty of an adverse economic event. Every day you live at risk. Some risks are more probable than others. Nevertheless, you cannot foresee when or if an event will occur for certain. For example, you will likely get into a minor fender bender at some point, and everyone will die someday. The first event is likely, the other inevitable. However, the timing of either event is unknown. Risks are also usually binary. You are alive or you are dead. However, the financial risks you protect against have a monetary component. For example, the expense of a fender bender is minor, whereas a head-on collision is major. You may be able to cover the minor costs of a fender bender, but a wrecked car would be more challenging to pay for out of savings. Thus, you transfer the risk to an insurance company by making monthly or annual payments for these significant, possibly financially devastating events. These payments or premiums are the cost you pay to transfer the risk to the insurance company. In return, the insurance company protects you from financial ruin by providing the cash you need if the covered risk occurs. Okay, so I suggest obtaining each of these risk management tools as quickly as possible to protect you and your family from financial ruin. If you can't afford all of them immediately, I would suggest, based on the likelihood of using these protections in the short term, accumulating a portion of your emergency fund first, then health insurance, disability insurance, and life insurance, and then accumulating the remainder of your emergency fund. However, don't wait if you can afford them all now. Okay, so we're going to start by reviewing each one. Now, once again, that's kind of just a general advice, but you may decide that for your particular circumstances, it would be better to do this in a different order. So this is not set in stone. All right, that's just real general advice. Okay, emergency fund. Cash is king. Why? Cash is the most liquid asset, meaning that you can easily and quickly use it to meet your immediate financial needs. Unlike other assets which need to be sold or converted, cash provides immediate flexibility to respond to unexpected expenses or emergencies. Having cash available also enables you to seize investment opportunities that might otherwise be unavailable. Right? If you have cash on hand, then you can take, and others don't, and you could potentially take advantage of good deals. Okay, cash reserves help you survive periods of reduced income during economic downturns and also provide a bridge that can sustain you during periods of unemployment. Okay, makes sense. Financial professionals commonly refer to this cash reserve as an emergency fund. You will always need an emergency fund no matter how rich you are. The only difference is that the amount will change. An emergency fund is essential but often overlooked because it is not exciting. Well, it's not meant to be. One of the things I enjoy about my family's emergency fund is the peace of mind it brings to me and my wife. Since the beginning of our marriage, we have tried to have an emergency fund in place, and there have been times when it has saved us from going into debt. It is something neither of us ever wants to go without. The money we initially saved to fund it and the money we've added to it over the years sits in our account and doesn't do anything. But that's okay. That is exactly what it's supposed to do. We don't look at it as money for investing, vacations, gifts, cars, or anything other than to save us in times of extreme emergency. Now, we might move our emergency fund to gain a little interest from a savings account, to a money market account, to a short-term certificate of deposit with total liquidity, but the interest earned is unimportant. The critical part of this money is that it is there when we have an emergency. The great thing about having an emergency fund is that it's not complicated. It's just an account with cash you don't touch except in extreme financial circumstances. You can keep the money under your mattress, although not recommended, in a bank vault, a checking or savings account, or a money market account. It doesn't matter where you stash it. You just need enough financial discipline to accumulate it and enough control not to spend it, except for in an emergency. Ideally, you will want a sum of cash equal to 3 to 6 months of living expenses. If you live in a 2-income household and feel that your employment is relatively secure, you could get away with 3 months of living expenses in cash. Because most likely, if there's unemployment, maybe only one spouse will be unemployed. The other will still be working, so there'll be some income still coming into the house. If you live in a 1-income household or are self-employed, I recommend at least 6 months. If you want to feel really secure in any situation, you might decide to save 12 months of cash for living expenses. If you don't have an emergency fund right now, do your best to start accumulating it as fast as possible, because any cash reserves will be better than nothing. Consider giving up some of your monthly wants, subscription fees, treats, snacks, car washes, salon visits, memberships, etc. for a few quarters during the year to fast track your emergency fund accumulation. Once you have it, take a deep breath and feel the financial pressure of emergencies roll off your back. You now have the resources to meet small, short-term emergencies and can plan for the future. All right, we're going to end there and pick it up in the next video with health insurance.